So let's get right to it. Our first question is from Henry in Little Rock, and he writes, I'm currently 53 and can see retirement in the distance. My wife and I both have 401ks through work, and we also have investment accounts that I manage on my own. What should we be currently doing to minimize our taxes in retirement? What are the gotchas, and he puts that in quotation marks, that we should be looking out for? Well, Henry, thanks for your question. This is a very common question, phrased differently, but the reality is the same. How am I going to deal with taxes in retirement? And this is a very big question, John, and I think the first thing I would say is, okay, based on the information that Henry gives us, he does have 401ks, both his wife and I. We're going to assume that those are pre-tax 401ks. Many 401ks, because he probably would have told us if he had a Roth 401k, which would mean that he's going to have tax-free money in retirement. But most likely, the 401k contributions and employer matches over the years have gone in on a pre-tax basis. And then he says he has investment accounts, and we don't know what type of investment accounts those are. But let's do a quick education on just the wrapper around the account matters when it comes to how your taxation occurs in retirement.
I'm going to swerve just a moment on this, Scott. One thing I want to focus in on from Henry is he says that he has investment accounts that he manages on his own. What are the gotchas that I've got to look out for? I think now is the time, Henry, that you begin to seek out wise counsel on a plan for retirement income. Now, you may say, I see retirement in the distance, and you did say that, and you're 53 years old, and I'm not saying that you have to take income from your retirement accounts now, but you need to be preparing for that eventuality. And I think that's where the rubber meets the road in getting someone who is well-skilled at all of the disciplines of retirement income planning, not just building up money for investments. A lot of people do manage their accounts on their own as they're building up assets, but we would say that first of all, the first thing you need is wise counsel to help you create a retirement income plan and an overall plan for your financial independence. Now, with that said, let's go back to Scott's question. Let's talk about the wrapper that's around those accounts. So accounts are taxed in a different way depending on the type of account it is. If it is a traditional IRA or a traditional 401k account, you're going to be looking at paying taxes on all of that money as it comes out because it's all went in, likely very much pre-tax. And so 100% of the withdrawal from those accounts of pre-tax qualified nature are taxable when you take that money out. Now, if you have a non-qualified account or a after-tax money account that you have put money into after you paid taxes on the principal, the only thing you owe tax on when you sell something from that is a capital gain tax that you would incur on the sale of that asset, or you may owe ordinary income tax on the dividend that investment might produce. And so taxation on those accounts are very different. And I think you've got to kind of figure out, first of all, what type of account that you've got and how that is going to be taxed. But let's also talk about the fact that right now would be the time that you get prepared for retirement, Scott, and look for having a significant amount of cash on the sideline when you get ready to pull the trigger.
Yeah, when you think about walking into retirement and many of your income streams being taxed, we do look at building a pretty good amount of cash for those early years. There's really a twofold reason for that. One, if it is in your bank account, it has already been taxed, so your net income need can be met dollar for dollar. You don't have to have a gross income and account for those taxes. You actually have all your net income you need right there in your savings account or your checking account in your bank. The other part of that is living off of that in the early years pushes the potential market volatility of the other investments down the road. In other words, if you're going to have a plan, which we hope you do, to provide yourself with a couple $1,000s a month out of your nest egg, then if you're taking it out of a cash savings or a CD or a money market fund, there's stability there that you know you can pull that $2,000 out and not have to sell an investment when it's down as the market has been over the last year and a half. So those are two big reasons, I think, and big pluses for cash savings, because what you're really trying to do, John, is you're not going to beat the tax monster here. There's no way that's going to happen. You're going to have taxation that occurs in retirement. Your Social Security benefit is likely going to be partially, if not majority, taxed. About 85% of it in most cases is going to be taxable. So you're going to have to pay taxes, but the more you can in your pre-retirement years create a tax-free income stream, the better. And the number one vehicle for that, really the only vehicle for that, is a Roth IRA. So the question becomes, especially for Henry, who's 53 and may have a decade before he's really planning to retire, how does he make that happen? Because what we've seen happen, John, is, I say this to clients all the time, the Roth IRA is the most underutilized investment vehicle, I think, out there. And much of the reason is we may start one when we're younger, but there are income limits that make you ineligible for direct contributions to a Roth IRA at some point. So if you become a pretty high income earner, especially as a family, as a household, you're taken out of that equation. But that is not the only way to get money into Roth IRAs.
No, you can convert money that is in a traditional IRA or a traditional 401k to a Roth IRA. Now, the caveat here is you got to have the money on the sideline outside of your retirement accounts to be able to pay the tax on that conversion. So you don't want to go willy-nilly and just go crazy and convert a big IRA to a Roth, because you're going to have a big tax bill when tax time comes. But what you do want to do is to take a careful look at what we call in our industry filling up the bracket. Mm-hmm. So let's say that you're in a 22% tax bracket. That is the top echelon of the tax bracket there as far as income is concerned at certain levels. But let's just say that your top bracket is 22%. And let's say the 22% threshold is here, but you're here as far as income is concerned. You've got some room to fill up that bracket with additional income and still be taxed at the 22% level as opposed to a higher level. And clearly, you want to save as much money as you possibly can in taxes. So filling up the bracket is a tactic that we look at for converting traditional IRA money to Roth IRA and being able to take advantage of future income that is tax-free. Now, the other equation here, Scott, is you've got to kind of look at what your time horizon is for using that particular bucket of money, because the real benefit of converting a traditional IRA to a Roth IRA is not necessarily going ahead and getting the taxes paid. It is the gain on that between now and the time that you retire. All of that gain is tax-free. And that's where the real benefit, I think, to most people are. That's why we encourage people who are changing jobs in their 20s and 30s to make a conversion of traditional IRA money to Roth IRA, because you can get a carload of tax-free income from the gain on that over the lifetime of that account.
Yeah, that's where I was going next, because a lot of people are in their 20s and 30s. If they leave a job and they weren't at the job for a terribly long time, it's not even a really big sum of money either. So maybe it's 5, 10, 15 grand that you've saved in your 401k. You've left your job. You can roll that over and convert it to a Roth IRA, pay the taxes on the $20,000 for that tax year. And really, again, when you say pay the taxes, it gets absorbed in your overall return. So if you were usually going to get a $1,000 refund, you may not get but $200 this year.
Something like that.
So you may not actually have to pay anything.
You can consult your tax advisor on exactly how that calculus works. But I think that's a great thing that you can look at.